Hello guys, welcome to another video, and in today's video I'm going to share 3 stocks that I think are undervalued at the moment. And if it's your first time joining, please consider subscribing to the channel. And for those who want to open a US brokerage account, there's a link in the bio. I have a video how to open a US account, US investment account, and there's a referral link. You can click that link and follow the instruction. The broker of choice with that link is Interactive Brokers. So when you're finished, you can just click on that link. Now, in today's video, I'm going to go through 3 stocks, and these stocks are stocks that I think is within my circle of competence. Please do your research, because each person has a different circle of competence, and at the same time, most persons might understand at least 2 of these stocks, but it's good to invest within your circle of competence. I am not a licensed financial advisor, so please do your due diligence. These are just my opinions and 3 stocks that I find favorable. First on our list today is Google, and the name Alphabet, but we all call it Google. Call them Google. So it's a holding company, and they have 3 segments: Google Services, Google Cloud, and other bits. And with Google, the Google service would include Android, Chrome, hardware, Google Maps, Google Play, and YouTube. And then you have Google Cloud segment, in which they provide infrastructure and platform services and collaboration tools like Google Docs, Gmail, and other services. And then you have other bets. These are other new business that they are investing and redoing their research. For example, they are doing research into health service companies and internet service. Now Google, they have a market cap of $1.4 trillion. Industry is commonly labeled as media, but I see them as a technology company that do media. And they have a price of free cash flow of 22 at the moment, at the time of this video, and they were trading at a price of about 110 when this video was recorded. Yes, correct. So they don't pay any dividend. That's one thing with Google. They're a growth company at the moment, and they haven't paid any dividend in their history. So if you're a dividend investor, this wouldn't be a good stock for you. But for those who are seeking higher growth, this is a good stock. And they trade on the Nasdaq with the ticker symbol GOOG. Now, financial health wise, this company is very healthy. They have a current ratio of 2.8, and their shares decreased by 2.6%. It's been decreasing over time now because they are buying back shares in their own company. And the company is also cash rich. They have cash more than their total liabilities by 125%. That means if the company should pay off all their debt, they would still have 25% cash remaining right now. So it's a very healthy company. And the company has about 10 ways that they generally make money. They have performance advertising, brand advertising, in which they help various brands to connect customers with the advertisers. And then you have Google Play. So they have generate revenue from the sales of their apps and digital content in Google Play Store. And then you have YouTube, non-advertising. And then you have also Google Cloud, Google Workplace, which is the collaboration tools such as Gmail, Google Docs, Calendar, and Google Meet. And they have other bets. These are new businesses that they are putting their money into and doing research. and these are companies that they expect to generate future revenue and income from. Now, when it comes on to return, Google has a return on assets of about 20%, return on equity of about 28%, and return on invested capital of about 27%. And these are very excellent numbers. Growth revenue has increased by 26% in the last year. Net income increased by about 14%. Free cash flow also increased by 11%. And the book value has been increasing also, and tangible book value. When it comes on to profitability, they have a net margin of 25%, which is very good. Operating margin of 29%, gross margin of 56%, and they have a high cash conversion. So Google actually, they have most of their revenue is actually cash. They don't have a lot of non-cash revenue. Now, when it comes on to the cash from operating activities, it has been increasing steadily over the decade. Over the last 10 years, they have consistently increased their cash from operations. Free cash flow is the same, likewise. It has been increasing steadily. From 2006, as you can see on the screen, they have been increasing their free cash flow. And they never yet, only in 2018 they had a drop, and I think they had a drop in 2013. But generally, there's a general uptrend when it comes on to their free cash flow. Now, when you look to their valuation, which is their comparative valuations, their PE ratio PE of 21 has been trading below their 5-year average of 32, which is very good. And their price to free cash flow of 23 is below their 5-year average of 31. So Google generally trade at least on a free cash flow of 21, and now they are at about 22. So Google is looking cheap by its historical standard. When it comes on to Google revenue, for 2022, for the last 3-month quarter, they had an increase to about $70 billion, almost $70 billion, from $62 billion. And their net income declined slightly to $16 billion from $18 billion. But that was only a small decline, and due to recession and various other macroeconomic factors such as global oil shortages and advertising spending less, Google actually saw a decline in their net income, but the company is still standing on solid ground. And now this shows a description of their revenue, which areas. So you have Google search, which majority of their revenue is generated. You have YouTube ads, which is third, and then you have Google network and Google advertising. Then you have Google Cloud, which is one of their upcoming businesses, and you have other bets. Now the stock price has decreased significantly over the last year, and we are now in a recession. They say sometimes the best opportunities are found in a crisis, and I think this stock is one that I will be increasing my position in. Now, second stock today is InMode, and InMode is a biotech company. They trade on the Nasdaq by the ticker symbol INMD, and they're selling at a price of $31.88 at the time of this video. And they also saw a significant drop because this stock was a stock that was selling near $80. So it has declined by over 50% over the last year. And InMode is a company that was founded in Israel. So it's an Israel-based company that develop and manufacture minimally invasive surgical, aesthetic, and medical treatment solutions. So this company basically create products for fat reduction, skin tightening. So it's a company that create products that plastic surgeons generally use and dentists. Yes. So I'm going to visit their website just to share their products and some of the procedures that physicians perform with their products. InMode, as you can see, it's a company that treat face, body, skin, and other areas of the body. Now I'm going to look at the patients before and after galleries. So these are some of the treatments. So they have hair removal, minimally invasive body contouring, minimally invasive face and neck contouring, non-invasive body treatments, pigmented and vascular lesions, and so I'm gonna look. So result before, after evoke. Before, after. So this is one of the products they call Body Tight. This is the after, before. So they also do ear removal as stated before. You can see it. Next. So trim, they also do trim and evolve after. Look, significant decline. So one of the popular products is the Body Tight, as shown before. So before, look at this before and after. So after. So yeah, we can see that InMode, we have an idea of the products and services. So guys, you can check out their website and then you can get a better idea of the type of services that physicians use their products for. So InMode, they're trading currently at a price of free cash flow of $14.64, and it's a company that have a market cap of $2.6 billion. And they are in the healthcare industry. So as I was telling you a while ago that about their price range, it was actually $99. So they are trading at a range of 99 to all the way down to 20 over the last 52 weeks. So when you come on to profitability, I haven't found a company with better numbers in such a long while. Because the gross margin is 84%, net margin 42%, cash conversion. So out of most of their sales and revenue, everything is cash basically. And cash from operation has been increasing significantly over the last 6 years. As you can see, where it's they have no other of cash from operations of $180 million, and revenue has increased by 40% over the last year. Net income 35%, free cash flow 26%, book value 36%, tangible book value 36%. Sometimes I wonder what is going on in the market at times. Like what are investors really thinking about when they actually sell off stock like these? Total revenue is now about $360 million from all the way down to about, I think it was 18 million. I will check back in a moment. But returns, when you come out to return, this is another company that is very strong. Return on assets 32%, return on equity 38%, return on invested capital 56%. Strong numbers. They had a quarterly revenue of $113 million, an increase of 30%. And total cash position at the moment is $443 million. And as you can see, this company has only two red flags that I saw when I was reading the annual report. They said in the annual report that they had low barrier to entry, so they really cannot stop most competitors in the future from really copying their products. When it comes down to trademark and patents, they say that if they don't continue to innovate, competitors over time will begin to copy them. So you know that this revenue might not last forever, but from what we can see over the last 6 years, we can see that this company has grown significantly. If you even go back before 2016, back to 2008, this company has been growing. There's never a moment that this company had a decline. Even during the pandemic, it had increased. So PE ratio of 15.4 is the lowest for its 4-year average, 40% by 40%. Price to free cash flow of 14 is below its 4-year average of 24. And price to sale is below its 4-year average of 10. So this is a great company that I will be adding in my portfolio. Financial health, they are debt free and they have a current ratio of 8.78. The shares decreased by 1.2%, which means they are buying back shares. And cash, they have more cash than total liabilities by 630%. So if this company should decide to sell all its assets, they have enough cash to pay all their investors right now. And you can see in comparison of the trade price, the company has significantly fallen as the market has basically battered the stock over the last year. So the stock was up near $100. Now it's trading around $31, $34, somewhere there in the low 30s. So this stock is definitely a buy for me. So number 3 on my list is a company that everyone might know, and this company is Meta, formerly known as Facebook. So Meta, at the time of this video, it was trading at a price of about $157, and they had a PE ratio of about 13. And this company has definitely been battered over the last year. It's now trading at a price where I would put some money into right now. I just recently put in a small position into this company, and I look into to increase this position in the near future. And 73% of these stocks is held by institutions. That's just to show you, even in institutional investors believe strongly in. And over the last 52 weeks, they have traded at from 154 to 384. So that's how far this company has fallen from $384 to now $157. So we all know Facebook, aka Meta. So Meta, they create social media platform to connect people and companies and friends and families. And also they are investing into the metaverse, which is virtual reality, and is something that they're building for the future. And they have companies that include augmented and virtual related consumer hardware and software and content. As you can see, the company operates in 2 segments: family of apps, Facebook, Instagram, WhatsApp, and other services. And they have also the virtual reality and augmented reality and content. They are now investing in content also. So the company has a market cap of $422 billion, and They have 2.6 billion shares outstanding. They are categorized in the media industry. But then again, I say this is a technology company that is in the media business, because a regular media business cannot do the things that Facebook do. So when you come out to revenue now, this company has increased their revenue by 14%, which is good. Their net income has decreased, however, though, by about 14%. And I'm going to share a short clip as to why their net income might have decreased. So one of the reasons I think is basically the iOS update, which is causing them to receive less data from Apple and iPhones. So this basically hinder them in gathering data for their ads, and this will affect them in the near future. But in the long term, I think they will work a way around this problem. However, their free cash flow though has been increasing though by 11%, which is very good. And when it comes on to Facebook financial health, this company is a very healthy company. So they have a current ratio of 2.52%. Their shares decreased by 5.7%, which means basically they buy back those shares, which is very good. And the company has a cash more than current liabilities, which is very good also, by 182%. So here we can see Facebook is a cash-rich company. And comes down to profitability, it's still a very profitable business. Despite decrease in the net income, it's still a profitable business, because the gross margin is 80%, operating margin 33%, and free cash flow margin of 29%, cash conversion of 106%. When it comes down to return on asset of 19%, return on equity 26%, return on invested capital of 29%. So when it comes down to valuation, their PE of 12.7 is now below their 5-year average of 26. So Facebook is selling at a valuation basically less than half of which the market normally value them. Their price to free cash flow of 12 is below their 5-year average of 28, which is good. Price to sales 3.6, below a 5-year average of 9. Excellent. 5-year stock growth of negative 7.5 now. So this is basically the market performance, how the stock perform on the market. And we know that in sentiments and how investors view the stocks right now contribute to this. So this doesn't really have anything to do with this company itself. So it's bad for those who invested before the crash of the stock, but now we can see in terms of the performance of the stock on the overall market, the stock has fallen by over 70% or 69%, as seen right here. For the 5-year stock growth of negative 7.75% is below the SPY returns of 61.6. So this is really the stock growth. This is the stock price, and sometimes the market will view the stocks pessimistically. So at this point in time, the stock price has performed poorly over the last year. Currently, the 5-year stock growth of negative 7.5% is below the SPY return of 61.6%. And we know this is due to the significant decline in their stock price. So this represents opportunity to buy the stock right now, in my opinion. So this is really opportunity. It's just has to do with the stock price, nothing to do with the company fundamentals itself. All right, so for the last 6 months, their revenue have remained flat, and their net income has decreased from 19 billion to 14 billion. Yeah, that's a big decline, but the company is still trading cheap relative to the price that investors are valuing the stock currently in the market. And so this is how the stock was trading 1 year ago, and this is where it is at now. It's time like these that you can grab opportunities and buy more shares of the stock and dollar cost average. Thanks to everyone who has been watching my videos. Please like and subscribe. Share your opinion. If you disagree with my picks, nothing is wrong with that. Let us debate that in the comment section. Yeah, see you in the next video.